Most people are one emergency away from financial ruin. Not because they made bad decisions, but because they had the wrong insurance. Or worse, no insurance at all. Today, we're going deep on the insurance industry, what they don't teach you in school, what the fine print really means, and how to use these products the right way. Chapter 1. What is life insurance and who actually needs it? Life insurance is one of the most misunderstood financial products on the planet. Most people think it's about dying. It's not. Life insurance is about replacing income. It exists to answer one brutal question. If you died tomorrow, would the people who depend on you financially be okay? Think about it this way. You are an income-producing machine. Every year you generate money that pays for rent, food, school, the mortgage, retirement savings, and more. If that machine stops, unexpectedly, there's a gap. Life insurance fills that gap. Here's who needs it. Anyone with dependents. That means children, a spouse who earns less or nothing, or elderly parents who rely on your support. If you're single, childless, with no dependents, and you have enough assets to cover your debts, you technically don't need life insurance right now. But that changes fast. The industry's dirty secret? Most people are drastically underinsured. A 2022 LIMRA study found that 41% of Americans say they need more life insurance, but haven't gotten it, citing cost as the main reason. Yet the same study found that most people overestimate the cost of coverage by 3 times the actual price. Chapter 2. Term life versus whole life. The truth the industry doesn't want you to know. There are 2 major categories of life insurance, term and permanent, and understanding the difference could save you or cost you tens of thousands of dollars over your lifetime. Term life insurance is exactly what it sounds like. You pay a premium for a set term, 10, 20, or 30 years. If you die during that term, your beneficiaries get the death benefit. If you don't die, the policy expires and you get nothing back. Sounds like a loss, right? Here's the thing. That's actually fine. Because term insurance is remarkably affordable. A healthy 35-year-old can get a $1 million 20-year policy for as little as $35 a month. Whole life insurance, also called permanent life insurance, never expires. It builds what's called a cash value that grows tax-deferred over time. Sounds better, right? Here's the problem. It costs 5 to 15 times more than equivalent term coverage, and the cash value growth is often slower than what you'd earn investing that premium difference in a simple index fund. The classic advice from most independent financial planners is this: buy term insurance and invest the difference. For most middle-class Americans, this approach provides the same death benefit protection at a fraction of the cost, while building far more wealth over time. But insurance agents who sell whole life earn much higher commissions, so that advice isn't always what you hear first. Chapter 3. The formula. How much life insurance do you actually need? There's a common rule of thumb: buy 10 to 12 times your annual income in life insurance. So if you earn $70,000 per year, you'd buy between $700,000 and $840,000 of coverage. But this is just a starting point. A more precise approach uses something called the DIME formula. D is for debt. Add up all your debts, including your mortgage. I is for income. Multiply your annual income by the number of years your family needs support, typically until your youngest child graduates college. M is for mortgage. What's the remaining balance? E is for education. How much would it cost to send each child to college? Add these 4 numbers together, subtract your existing savings and any life insurance you already have, and that's your coverage gap. This is the number your policy needs to cover. Most financial advisors also recommend reviewing your coverage every 5 years or after major life events, a new baby, a home purchase, a divorce, or a significant salary change. Life insurance is not a set-it-and-forget-it product. Your needs evolve, and your coverage should too. Chapter 4. Health insurance, decoding the language that keeps you confused on purpose. Health insurance might be the most confusing product ever created, and that confusion isn't accidental. Let's break it down clearly. Your premium is what you pay every month just to have coverage, whether you use it or not. Your deductible is the amount you pay out of pocket before your insurance starts sharing costs. If your deductible is $3,000, you pay the first $3,000 in medical bills yourself each year. After you've met your deductible, you enter cost-sharing territory. You'll pay a copay, a flat fee per visit, or a co-insurance percentage like 20% of each bill. Your insurance covers the rest. This continues until you hit your out-of-pocket maximum. The out-of-pocket maximum is the most important number in your health plan that most people ignore. It's the absolute most you will pay in a calendar year. Once you hit that number, your insurance covers everything at 100% for the rest of the year. In 2024, the federal out-of-pocket maximum for a marketplace plan is $9,450 for individuals. High-deductible health plans, or HDHPs, have lower monthly premiums but higher deductibles. They pair with a health savings account, an HSA, which lets you save money tax-free specifically for medical expenses. If you're generally healthy and rarely need care, an HDHP with an HSA can save you significant money year over year. Chapter 5. Auto Insurance, the coverage choices that could change everything. Every state requires some level of auto insurance, but the required minimum is often dangerously insufficient. Here's what you actually need to know. Liability coverage pays for damage you cause to others, property and injuries. Most states require it, but the minimums are low. If you cause a serious accident and your liability limit is $25,000, but the other driver's medical bills are $200,000, you're personally responsible for the difference. Liability limits of $100,000 per person and $300,000 per accident are much safer. Collision coverage pays to repair or replace your vehicle after an accident, regardless of fault. Comprehensive coverage handles everything else: theft, vandalism, weather, hitting a deer. Both come with a deductible that you choose. A higher deductible means lower premiums and more risk you absorb. A lower deductible means higher premiums and more protection. Here's the strategic insight. If your car is older and worth less than $3,000, paying for collision and comprehensive coverage may not make financial sense. The insurance company will only pay up to the car's actual cash value. If that value is low, you may be paying more in premiums over time than you'd ever recover in a claim. Close and how to take control of your insurance today. Insurance is not just a bill you pay because you have to. It is the financial fortress that protects everything you've built. The people who get insurance right don't just buy it, they understand it. They review it, they optimize it as their lives change. Here's your action plan. First, get a free term life insurance quote online. You'll be surprised how affordable it is. Second, read your health plan's summary of benefits, especially the out-of-pocket maximum, before you need care, not after. Third, check your auto liability limits today. If they're at the state minimum, raise them. Financial security isn't just about growing wealth. It's about protecting the wealth you have, and insurance used correctly is the most powerful protection tool available to ordinary people. If you found this valuable, subscribe to Insure Smart. Every week, we break down complex insurance and financial topics so you can make smarter decisions with your money. Hit the bell icon so you never miss an episode. Your financial future is worth understanding.